Okay, I guess I am live, and I wonder if I can share my screen so you guys can see what I'm looking at. What does that thing do? That doesn't do anything. That's a microphone. What does that button do? That button is a share button. Don't want to share. Is there a desk? Can I share my desktop? Pop out chat, toggle, timestamp, say something. I don't think this is going to let me do what I want to do. All right, I'm just going to roll with it. I'm going to put this thing here, put this thing here, and you guys are going to see me reading a bunch of stuff. So anyway, what's up? What's up? So I'm checking my news feed, and like the Fed is lighting up everything, and I like to talk about economics, so why not? So if you're not aware, which looking at my news feed, I don't know how you couldn't be. The Fed did something today. They raised their interest rate that they loan to banks. They raised it from 2% to 2.25, and everybody lost their mind. So I'm going to talk a little bit about context and why. Um, I think this will be interesting, entertaining to hear me um, talk stupid about complicated things, because I don't think it's that complicated. And I'll try to leave the boring stuff out. So anyway, I'll put links maybe in the description after. It doesn't really give me the option to put anything now. Actually, I can do this. I'm gonna put a link in the comments. So I'm reading some stuff, and I'll link out to it in the comments. I'm at a Reuters article. Fed raises U.S. interest rates. And the headline is, they see at least 3 more years of growth. So that's their prediction, is that they expect the economy to continue to grow. I think it was above 3% for the next 3 years at least. It says in a statement that marked the end of the era of, quote, accommodative monetary policy, Fed policymakers lifted the benchmark overnight lending rate by 1/4 percentage point. Okay, what does this mean? What is this accommodative? Because if depending on what you're reading, people are making a big thing about this word. It's a little bit of a history lesson. I'm going to go over to my gold chart. You know, I don't like this chart as much. I'm going to do a search for gold. That's what I want, gold index. This is what I was looking at before. Max it out. The HUI. Okay, is there, can we make this bigger? Can't really make it bigger. All right, so history lesson. We're here in 2006, 2005. The economies, this is George W. Bush right here. In 2009, this right here is the Great Recession. Oh, you're looking at me. I'm looking at a chart. I'm an idiot. All right. I can't share this, and that kind of sucks. I kind of want to cut the video off. Anyway, I'm going to push forward. So if you look at the HUI gold index, which I will link out to what I am, put that in the link if you want to see it. You can see it in the link. It's a Google search for gold. HUI gold index. You had the financial crisis in 2009. And then you had what was a weak economy for the next pretty much until 2013-ish. So that's what, 3-4 years, 10, yeah, 4 years, where essentially what banks did, what the Fed did, is they loaned money to banks at 0%. And then the banks turned around and lent it to us at 4, 5, 6%. So they basically were just printing money for 3 or 4 years to shore up their balance sheet, make nice, healthy profits because the economy was on life support. So now, pretty much end of Obama, beginning of Trump, the Fed started increasing that amount of money that they loan to banks for, and so it was at 2%. It's now at 2.5, and basically their goal is to eventually get it to 3.4%, which is half a percentage point above what the Fed estimates as a neutral rate. So the Fed thinks that 3% is neutral. That's not helping the economy, it's not hurting the economy. 2.25 is still helping the economy. And they're slowly going to get it over the course of the next from now, I think towards the end of this year. I might be reading it wrong, but by the end of this year, beginning of next year, they want to get it to that 3.4%, and they're gonna be raising it to get to that rate. So that's what they did today. They started that process. And the reason is, well, if you look at the stock market, that's the reason why. It's on an absolute tear. And so because the economy is doing so well, they are increasing that rate. And Reuters published a headline: Wall Street rally disintegrates shortly before the close. I didn't see it. It was slightly lower. I wouldn't say S&P 500 fell 1.27%, leading the decline. I think the economy is still on a tear. And then the other headline was that gold prices slipped. They didn't slip. They're down 0.5%. So gold is roughly trading about $1,200 an ounce. Today it closed at $5 less. That's not a slip. That's a statistical anomaly. Any case, where am I at with this? Why is this important? I think the big headline for me is the Fed thinks that the gravy train is going to last 3 years. And why 3 years? Well, I figure either Donald Trump is going to be in the White House for 2 years or the next 6 years. And 3 years is the estimate they want to go with. If that's not the number one reason, which I started to Google their reasoning. If you want to wait for the Fed minutes, you can read that in a few months and see what their reasoning was in a few months. But if that's not the number one reason, it's in the top 3. A lot of people don't like Donald Trump, but he is the absolute foundation of this tear in the market that we've seen. And so the fact that he's doing what he's doing, the tax cuts, all of that is driving the market just higher. And so for as long as he's around, the market's going to keep going up. It just is. And so you can probably take that to the bank. And I think that's the basis of their estimate, is just the political cycle and how things go. And if things change in 2020 and someone else takes over, then I could see businesses decide, we're not going to be as, loose with our investments, and they might start reining things in a little. But I think this stuff is really interesting, and I hope, if you're still watching, 8 minutes into this rant/rambling of my almost 9 minutes, you must like it too. So hit the like button. Let me know that you liked it, that you want to hear more about finance type stuff. I wanted to, if you watched my video yesterday, I was talking about SurveyMonkey. I got owned. I was bearish on SurveyMonkey at $12, but a lot of other people thought differently, drove the stock price almost to $18. So like almost 56% surge. And the $12 starting price was actually significantly higher than where they were originally going to start at 8 or 9. So people love them some SurveyMonkey today. And actually, I really appreciate the comments that I got. I got some direct messages. I got hit up on Facebook. A lot of love for SurveyMonkey, and I like the product too. I think it's great. I'm not a fan of the stock. So that is my tear on interest rates. If you want to hear more about this kind of stuff, hit the like button. If you want to hear more from me, hit the subscribe button. And that's it. I'm out.